Hey everyone, this is John from Blueprint. Today's February 28th, 2023, and this is the monthly asset allocation update video. In this month's video, we'll talk about the asset allocation changes as we head into March, pursuant to our systematic investment strategies, and which asset classes will increase or decrease exposure to going into the next month. In fact, the last month of the first quarter of 2023. We also write what we call the co-founder's note in conjunction with producing this video, where we write this month about good news and bad news, and we take a look at U.S. stocks through the lens and framework of the fundamental backdrop, what's going on economically, the sentiment being driven by seems every week something from the Fed, inflation data, interest rates, etc. So if you haven't gone back to read that, I would encourage you to do so. So in terms of the asset allocation changes heading into March, U.S. equities. We maintain an intermediate term rising trend in U.S. equities and a downtrend in the long term. However, the exposure will increase. And if you're familiar with our strategies or you've watched these videos in the past, you'll know that we have what we call a risk handoff process, which takes exposure from downtrending assets and pushes it towards those that are still in a rising trend. So while U.S. equities has no trend change month over month from February to March, its exposure will rise a little bit as it receives the handoff from real estate. Foreign developed equities, overall exposure will not change. However, the exposure to emerging markets will change as we have downtrends over both timeframes. And what will happen there is emerging, because it's in a downtrend over both timeframes, that exposure will get pushed to foreign developed. So similar to U.S. equities and real estate, the same thing is happening with foreign developed and emerging. No change to the state of the trend. However, the asset class will increase in exposure because of the handoff process. Real estate, as you might imagine, will decrease because we now have an intermediate term downtrend. The long-term trend there has remained down. It's remained down for over a year now. And that exposure, as I said before, will just simply get pushed to U.S. stocks. Exposure to treasuries will decrease to their minimum levels. Treasuries last month, we increased duration slightly as we saw an intermediate term trend in longer duration bonds. That has since reversed, and that exposure will get pushed down on the yield curve to shorter term duration cash equivalents. Inflation protected bonds, there's been no change there for a while. They remain at their minimum allocations because of downtrends over both timeframes. Gold will not change. We use gold to express our alternatives allocation. It is currently at its maximum allocation, which is the same thing as its baseline. So we're as high as we can go in gold depending on the strategy. And it maintains rising trends over both timeframes as well. So short-term fixed income or cash equivalents, this exposure will increase as it receives the allocation from longer duration treasuries, which have now reverted back to downtrends over both timeframes. So there's a lot going on in the portfolios this month. Not a lot of trend changes, but a lot of shifting, because those things that are where the trend is changing, that because of our handoff process, that exposure will get pushed to different areas of the portfolio. So if you take a look at what this looks like graphically, what we've really highlighted here is by the arrow is that because of the downtrend in emerging shifting to foreign developed and real estate shifting to U.S. equities, that exposure will increase even though there's no change to the state of the trend in either of those two asset classes. So what are the key takeaways? Well, U.S. equities remain in an intermediate term uptrend and a long-term downtrend. However, that exposure will increase because of the handoff process we have from real estate being now in a re-emerging downtrend in the intermediate term time frame, getting pushed to U.S. equities. And lastly here, good news and bad news. In this month's note, we write about, okay, what's the good news? Well, the good news is that U.S. equities have broken through this long-term downtrend line, not an indicator or any part of our system whatsoever, but just visually you can see that this long-term downtrend line that it's experienced over the course of the past year has now been broken. However, the minute it was broken, or within a week or two after it was broken, it reverted and is now closing the month of February, at least in the S&P, closing the month down. So there's good inflation data that comes out, and there's bad inflation data that comes out. And this is going to drive sentiment day over day, week over week, month over month. However, for us, what it does is it reminds us to stay focused on first principles. And we used a Warren Buffett quote this month, which talks about how effectively in the course of his investment career, a few decisions have made up the lion's share of their gains. And he refers to it as, as the flowers bloom, the weeds wither. And for us, when we read that, that is it's a very clear analogy to trend following. Trend following is all based on cutting your winners short, so selling things that move against you over the time frames that you utilize, and letting your winners persist or letting your winners run on. And so for us, in these environments of choppy markets in many cases, sideways markets in many cases, volatility ebbing and flowing, it's important for us to focus on first principles. And that is reminds us of our primary goal, which is to design strategies that help you meet your clients' goals. And that's what we're really focused on. So whether we're in a bull market of low volatility or in a bear market of rising volatility, our systems, our strategies, because they're rules-based, are always on, and they're always managing risk, and they're always diversified. And so these are just some of the first principles that we pay attention to as we manage money, because we know these environments are going to happen. History's told us they're going to happen. We expect them to happen. We're not surprised by these types of markets. But what we want to do is really do our job well so that you can do the job of financial planning, of talking to clients, and really helping shepherd clients through these types of environments to hopefully what amounts to more favorable environments later to help increase their rate of compounding to meet their goals. So we're nearing the end of at least coming close to the end of the first quarter. And we ask this in every video, and many advisors, every time we ask this, take us up on it. We love that. So what can we do for you? I'm sure many of you are having meetings now talking about taxes, talking about tax planning, talking about maybe updating client goals. How can we help you with that? Recently, we've done calls where advisors will invite their clients on the call. We'll talk about what our strategies have done, are doing, what the rules are, put that in the context of what's happening in the economy to be relatable, and then allow clients to ask us questions. And we've seen that this has been really impactful and is a great value add by you, the advisor, that you have that kind of relationship with a partner that's managing the client assets. So if any of that rings true for you, or it spurs an idea that you'd like us to work in conjunction with you on, I'd invite you to reach out to us. You can go to the website, blueprintip.com. You can contact me directly via email or via phone. That's all on the screen here. Reach out to us. Let's brainstorm and let's figure out what works best for you and your clients. So with that, thank you for your time. Thank you for your attention. And I look forward to seeing you back here at the end of the first quarter, at the end of March. Thank you.